Warren Buffett has long been known as a very long-term investor, somebody who buys stocks and often holds them for decades at a time. So when he starts selling a stock, investors should take notice. And the biggest sale that we found out about over the last weekend was Buffett selling a large portion of his stake in Apple. In fact, about 115 million shares have been sold by Berkshire Hathaway. This is by far the biggest sale that Buffett has made since building a stake in the mid-2010s. This is a stock that was about half of Berkshire Hathaway's equities portfolio. So I think this is extremely notable if you are an Apple investor in particular, because one of the biggest and most successful investors in the world is now taking chips off the table. I have actually been doing the same with Apple as well, in large part because I don't like the company's growth trajectory or its valuation. And I think Buffett might be seeing some of the exact same things. On top of that, it's not clear what the catalysts are going to be for Apple going forward. The Vision Pro has obviously not been particularly successful, although that may be a product that takes 5, 10, 15 years to really get off the ground. It's not clear what Apple's play is in artificial intelligence. The iPhone is stagnated. So I want to go through the numbers today and highlight what Buffett might be thinking. Now, he said this is a stock that he's going to own long term, so he's kind of downplaying these sales. But let's take his actions over what he said over the past weekend and look at why he may be selling Apple stock. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So let's go through Apple step by step. And I'm going to start with the iPhone. This chart shows iPhone revenue on a trailing basis. So this doesn't have the same quarterly swings as you have when you look at a single quarter for Apple. But on a trailing basis, since the September 2020 quarter, you can see that sales have essentially been flat for 2 years now. And this is alarming for a couple of reasons. One, the iPhone is obviously Apple's most important product, so you want to have that core product be growing. But two, prices are starting to go up. So if revenues are not increasing as the price per unit is increased, that means the number of units that are actually being sold is starting to go down. And that's, I think, something that we're seeing across the board for Apple as a possibility, is that if revenue is actually going down as prices are going up with a lot of their devices, then their volumes are going down, they're losing market share. Now, this can be blamed on the elongation of the refresh cycle, so people aren't buying phones quite as often as they used to. You've stretched to 3 or 4 years maybe. That can be a part of the picture. But later on, I'll get to the valuation of Apple. And if these products aren't growing, you have to wonder what we should be paying for Apple as a stock. And I think that's where those two things collide. The second thing to look at is Mac revenue. This one I think is just shocking because you can see the impact of the pandemic here. During the pandemic, they were having an increase in sales. They were coming up with more of their Apple designed silicon, but that increase in sales did not last. And we're now down to about a $30 billion per year run rate in Mac sales. So clearly not a particularly strong product, actually declining over the last few years. Probably not something that we can count on a lot of growth given the maturity of that market as well. The iPad, similar story. Sales just generally kind of slowing over the last few years. Not a lot of really impressive refreshes, so we'll see if something changes at an event later this week. But this is, again, another disappointing product for Apple. But the next two segments is really where we've seen growth over the last decade. Wearables was a massive driver of growth after the introduction of the Apple Watch and AirPods. Those two products alone have been great additions to the Apple ecosystem. You can see that revenue jumped to over $40 billion per year. But again, that has been on the decline since the September 2022 quarter. So basically a year and a half of declining revenue for wearables. The other growth driver has been services revenue. And you can see that services revenue is continuing its growth march, now at $90.5 billion. This includes everything from the payment they get for Google to be the default search engine in Safari, to the 30% cut that they take from app downloads, to Apple TV. So there's a lot of different products that are included in this, but you can see that this is really the only growth driver that they have. And services revenue really depends on the growth in the number of users in the ecosystem. So iPhone sales, iPad sales, Mac sales, this is all going to drive services revenue long term. If you're seeing declining sales of your core hardware products, eventually that is going to impact this services revenue. And that's, I think, where we need to start getting skeptical about what we're buying with Apple, how much growth this company can have long term. how long is it going to be at the top of the mountain, and what the valuation is. And so that's what I want to dig into next. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. This chart is a look at Apple's price to sales multiple and price to earnings multiple since 2016. And I'll just give these numbers here. In mid to late 2016, the price to sales multiple was about 2.7 or 2.8. Right now, that multiple is just over 7. So the price to sales multiple has more than doubled. The price to earnings multiple in that same time period was right around 13 or 14. Right now, the price to earnings multiple is 28. So Apple as a company is much more expensive for the revenue and for the earnings that you're getting than it was in 2016, 2017. At the same time, the growth rate has declined. Apple's growth rate from 2016 to 2021 was 11.1%. Since 2021, fiscal 2021, the growth rate on a compound annual basis is 1.7%, so slower than inflation by a very wide margin, given the fact that inflation has gone up over that period of time. So should we be paying a multiple that is 2 to 3 times higher today for Apple than what we were paying in 2016? And I think this is what Buffett is looking at. When he was buying shares of Apple at a price to earnings multiple, price to free cash flow multiple in the low to mid teens, that he saw as a really attractive valuation. The company could do a lot of things with cash. They could reinvest in the business. They could buy back shares. They could issue dividends. All of those things would be accretive and would help Buffett stake long term. But now we're looking at a company that's trading at a much, much higher valuation. Apple announced last week that they're going to add $110 billion to their buyback authorization. Well, I have to question why you're buying back the stock of a company that's trading for 30 times earnings and those earnings aren't growing. That's really the fundamental question for Apple is if you just have too much cash, you should just be returning it to shareholders to allow them to do what is best with it. Because I don't think buying back shares at a 30x multiple or nearly a 30x multiple is going to be the best use of capital. And so I think what we're seeing Buffett say is, hey, I'm just going to take at least some of my chips off the table because this is an expensive stock and they clearly don't have investment opportunities on the scale of the cash that they're generating each year. And if what they're going to do with their cash is just continue to buy back stock and not return it to me as a shareholder, I'm going to be out. And so that's why I think that is a very clear reason why Buffett has been taking some chips off the table. I have also been selling Apple over the last year or so just based on these valuation numbers, based on the fact that the business just fundamentally is not doing as well as it was before the pandemic. We had a huge pandemic growth curve, but now there's just not that much inspiring things going on at Apple right now. So not a company that I want to pay premium for, and I think we're seeing the exact same thing from Buffett. This doesn't necessarily mean that Apple's stock is going to go down in the near future, but what Buffett does is something we should keep in mind as investors, and I think he's seeing the same things that are obvious to a lot of us out here saying Apple is just too expensive right now. So it's a great time to sell and raise cash, even though he doesn't want to have that cash on the balance sheet. So what do you think about Buffett's move to sell about 15% of his stake in Apple? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.